Video 21, Part 14b of 25, Inputs to the Determine Budget Process. The purpose of this video is to develop a WBS to present the inputs to the Determine Budget Process. The Determine Budget Process is the third process in the Project Cost Management knowledge area and is related to the Planning Process group. Please click the like button. Subscribe to my channel and share with others. How important is the input of project management plan to the Determine Budget Process? The project management plan is a critical input to the Determine Budget Process in PMBOK because it provides the foundational guidelines and components necessary for accurate budget estimation. Here are the key components of the project management plan used in Determine Budget. 1. Cost Management Plan. The project management plan defines how costs will be estimated, budgeted, managed, and controlled. The project management plan specifies the level of accuracy, control thresholds, and rules for contingency reserves. 2. Scope baseline, such as Scope Statement, WBS, and WBS Dictionary. The project management plan ensures all project work is accounted for in the budget. The project management plan helps prevent scope creep, which can lead to cost overruns. 3. Schedule baseline. The project management plan provides the timeline for cost allocation, such as phased funding requirements. The project management plan helps in forecasting cash flow and time-phased budgeting. 4. Risk Management Plan. The project management plan identifies known risks that may require contingency reserves. The project management plan influences the determination of management reserves for unknown risks. 5. Resource Management Plan. The project management plan details labor, materials, and equipment costs, which are key inputs to budget determination. How can a poor project management plan analysis harm the Determine Budget Process? A poor project management plan analysis can severely undermine the Determine Budget Process, leading to inaccurate budgets, cost overruns, and project failure. Here's how a poor project management plan analysis harm the process. 1. Inaccurate budget estimates due to poor scope definition. If the scope baseline, such as WBS and scope statement, is unclear or incomplete, the budget may exclude critical work packages. As a result, this can lead to unplanned costs, scope creep, and funding shortfalls. 2. Unrealistic cost assumptions from a weak cost management plan. A poorly defined cost management plan may lack clear estimation methods, control thresholds, or contingency guidelines. As a result, the budget estimates may be too optimistic, ignoring risks or inflation, resulting in cost overruns. 3. Misaligned schedule and budget from poor integration. If the schedule baseline is not properly analyzed, time-phased budgeting, such as monthly cash flow, may be incorrect. As a result, this can lead to funding gaps or idle resources, disrupting project execution. 4. Inadequate risk reserves due to poor risk planning. A weak risk management plan may overlook high-impact risks or underestimate contingency needs. As a result, the budget may lack sufficient reserves, forcing emergency funding requests or project delays. 5. Resource cost miscalculations from poor resource planning. If the resource management plan is flawed, labor, materials, or equipment costs may be underestimated. As a result, this can lead to budget shortfalls, forcing cuts in other areas, or compromising quality. 6. Lack of stakeholder alignment leading to budget conflicts. Poor stakeholder engagement planning may result in mismatched expectations. As a result, this can lead to delays or disputes in budget approval, resulting in rework and wasted effort. 7. No clear change control process, leading to uncontrolled costs. If the project management plan lacks a formal change management process, unauthorized changes can inflate costs. As a result, budget baseline becomes meaningless, making it impossible to track costs. In conclusion, the project management plan is essential for determined budget because, first, project management plan ensures alignment. The budget must align with the project's scope, schedule, and resource plans. Second, project management plan provides governance. The project management plan outlines approval processes and cost control mechanisms. Third, project management plan supports accuracy. Without a well-defined project management plan, budget estimates may be incomplete or unrealistic. Fourth, facilitates stakeholder communication. The approved project management plan serves as a reference for justifying budget decisions. An inadequate analysis of the project management plan can have budgetary consequences such as the following. First, budget overruns due to missing or underestimated costs. Second, project delays due to funding shortages or re-estimates. Third, stakeholder dissatisfaction due to unrealistic financial expectations. Fourth, increased risk of project failure due to poor financial management. As a final message, the project management plan is vital to the determined budget process because it integrates all planning documents that influence cost estimation, ensuring a realistic, controlled, and well-justified budget. Without it, budgeting would lack structure, leading to potential financial mismanagement. How important is the input of project documents to the determined budget process? The input of project documents is critically important to the determined budget process. The determined budget process involves aggregating the estimated costs of individual activities or work packages to establish an authorized cost baseline. Key project documents that influence the determined budget process. 1. Cost estimates. The foundation of the budget, providing detailed cost projections for project activities. 2. Basis of estimates. Justifications and assumptions behind cost estimates, ensuring accuracy. 3. Project schedule. Helps in time phasing costs, such as cash flow analysis. 4. Risk register. Identifies risks that may require contingency reserves. 5. Resource requirements. Details on labor, materials, and equipment costs. 6. Agreements, such as contracts and procurement docs. Contains external cost commitments, such as vendor contracts. 7. Lessons learned register. Contains historical data from past projects to refine budgeting. How can a poor project documents analysis harm the determined budget process? A poor analysis of project documents in the determined budget process can lead to significant financial, operational, and strategic risks for the project. Here's how a poor analysis of project documents can cause harm. 1. Inaccurate budget estimates. Flawed or incomplete cost estimates, basis of estimates, or resource requirements can result in, first, underestimation of costs, leading to budget shortfalls and the need for emergency funding. Second, overestimation of costs, leading to unnecessary fund allocation, reducing ROI. For example, the lack of material cost escalations in contracts leads to unexpected expenses. 2. Poor risk and contingency planning. Inadequate risk management analysis, such as the omission of high-impact risks, can result in inadequate contingency reserves, such as a lack of financial resources for a project when risks materialize. For example, ignoring supply chain risks results in unbudgeted procurement delays. 3. Misaligned budget and schedule. Failing to integrate the project schedule with cost estimates can result in cash flow problems, such as front-loaded spending versus delayed milestones. For example, budget assumes year 1 completion, but delays stretch costs into year 2. 4. Scope creep and uncontrolled changes. Poorly defined scope baseline or change requests documentation can result in unapproved scope changes that inflate costs without budget adjustments. For example, new features added without budget realignment can result in cost overruns. 5. Stakeholder and sponsor distrust. Unsupported budget assumptions, such as lack of basis of estimates, can result in that leadership rejects budget due to lack of transparency. For example, sponsor challenges a budget with no historical data backing estimates. 6. Contract and procurement risks. Incomplete agreements or procurement docs analysis can result in unaccounted vendor costs, such as penalties and change orders. For example, fixed-price contracts without inflation clauses may require the supplier to make additional payments. 7. Inefficient resource allocation. Poor resource requirements analysis can result in overstaffing or idle equipment, resulting in wasted budget. For example, budget assumes 10 engineers, but only 5 are needed. In conclusion, these documents are important because, first, accuracy and reliability. They ensure that the budget reflects realistic cost expectations. Second, risk management. They help allocate contingency reserves based on identified risks. Third, stakeholder confidence. Transparent documentation supports budget approvals. Fourth, compliance and control. They align the budget with the project scope and schedule. Without proper project documents, the determined budget process would lack precision, leading to potential cost overruns, misallocation of funds, and stakeholder disputes. Thus, these inputs are essential for developing a credible and controlled project budget. As a final message, a poor project documents analysis undermines the determined budget process by introducing errors, risks, and misalignments that can derail project success. Rigorous documentation review is non-negotiable for budget accuracy and control. How important is business documents input in the budgeting process? Business documents input is critically important to the project management budgeting process. And here are the reasons why it's so important. First, strategic alignment. Ensures the budget supports business objectives. Second, funding justification. Stakeholders and sponsors rely on these documents to approve budgets. Third, risk and assumption validation. Business documents highlight financial risks and constraints that impact the budget. Fourth, governance and compliance. Ensures adherence to the organization's financial policies. The key documents are: 1. Business case. This document justifies the project's value and financial feasibility, provides cost-benefit analysis, ROI, and high-level budget estimates, and also ensures the budget aligns with strategic objectives. 2. Benefits management plan. This document defines how project benefits will be measured and realized. It also helps prioritize budget allocation to maximize value delivery. 3. Project charter. This document contains initial funding approvals and high-level constraints. It also sets the financial boundaries for budget development. How can a poor business documents analysis harm the determined budget process? A poor analysis of business documents can severely undermine the determined budget process, leading to financial misalignment, stakeholder distrust, and project failure. Here's how a poor analysis of business documents can cause harm. 1. Inaccurate budget estimates. If the business case or benefits management plan are not rigorous, initial cost estimates may be unrealistic. This can result in budgets that are too low, leading to shortfalls, or too high, causing unnecessary constraints. For example, underestimating costs in the business case can force mid-project cuts, delaying deliverables. 2. Misalignment with strategic goals. Weak strategic justification in business documents may lead to funding mismatches. This can result in wasted resources on low-priority activities, while critical tasks face underfunding. For example, a project approved without a strong ROI case may later face budget cuts when stakeholders question its value. 3. Unrealistic funding approvals. If the project charter lacks clear financial guarantees, sponsors may approve unfeasible budgets. This can result in the project starting with insufficient funds, requiring disruptive baseline resets later. For example, a project charter that omits key assumptions, such as inflation rates, leads to budget overruns. 4. Poor risk and assumption handling. Business documents that ignore risks or rely on flawed assumptions distort budget contingencies. This can result in unexpected costs arising but without the allocation of reserves. For example, a benefits management plan that assumes stable supply chain costs fails when market volatility intensifies. 5. Stakeholder and sponsor distrust. If business documents are poorly analyzed, executives may reject budget requests or micromanage finances. This can result in loss of credibility for project management, leading to stricter controls and slower approvals. For example, a vague business case erodes trust, causing sponsors to withhold contingency funds. 6. Compliance and governance failures. Weak documentation may violate organizational or regulatory financial policies. This can result in audits that flag discrepancies and freeze project funding until they are resolved. For example, a public sector project without an adequate cost-benefit analysis faces legal challenges. In conclusion, business documents provide the foundation for realistic, justified, and approved budgets. Without them, the determined budget process lacks strategic direction and financial credibility, and the consequences are: first, misaligned budgets that don't deliver expected value. Second, funding rejections if the budget lacks business justification. Third, cost overruns due to unrealistic assumptions. As a final message, a poor business documents analysis corrupts the entire budget foundation, leading to cost overruns, misallocations, and even project cancellation. A rigorous upfront analysis is non-negotiable for PMBOK-aligned budgeting. How important is the input of agreements to the determined budget process? The input of agreements is highly important to the determined budget process, as they directly influence the financial planning and cost baseline of a project. Here's why. 1. Foundation for procurement costs. Agreements, such as contracts, purchase orders, or service-level agreements, provide legally binding cost estimates for externally procured goods, services, or results. These costs must be aggregated into the project budget to ensure accuracy. For example, vendor contracts for materials or subcontractor fees are explicitly included in the budget calculations. 2. Integration with cost baseline. The costs outlined in agreements are rolled up into the project's cost baseline, which serves as the benchmark for performance measurement. Without incorporating these costs, the baseline would be incomplete, leading to misalignment between planned and actual expenditures. 3. Risk and contingency planning. Agreements often include terms related to penalties, incentives, or cost adjustments, such as those for delays or scope changes. These clauses impact contingency reserves and risk response costs, which are factored into the budget during reserve analysis. 4. Funding reconciliation. Projects with phased funding must align procurement payments with funding cycles. Agreements help reconcile expenditures with available funds, ensuring the project doesn't overspend in a given period. 5. Compliance and stakeholder alignment. Agreements reflect stakeholder commitments, such as client-funded milestones or vendor deliverables. Their inclusion ensures the budget adheres to contractual obligations, avoiding disputes or financial shortfalls. How can a poor agreements analysis harm the determined budget process? A poor agreements analysis can significantly harm the determined budget process by leading to financial inaccuracies, project delays, and even contractual disputes. Here's how a poor agreements analysis can cause harm. 1. Inaccurate budget estimates. First, missing or underestimated costs. If agreements, such as contracts, purchase orders, etc., are not thoroughly analyzed, key costs, such as vendor fees, penalties, or incentives, may be excluded, leading to an unrealistic budget. Second, unaccounted payment terms. Some contracts may include milestone-based payments, retainers, or variable pricing, such as cost-plus contracts. Poor analysis could result in cash flow mismatches. 2. Increased financial risks. First, unplanned contingency costs. Agreements often contain clauses for delays, scope changes, or penalties. Failure to account for these may deplete contingency reserves prematurely. Second, hidden liabilities. Poorly reviewed contracts might include unfavorable terms, such as automatic price escalations, leading to unexpected cost overruns. 3. Misalignment with project funding. First, funding shortfalls. If procurement costs from agreements are not synchronized with funding limits, the project may face liquidity issues mid-execution. Second, incorrect cost baseline. The budget may not reflect contractual obligations, causing discrepancies between planned versus actual spending in earned value management. 4. Contractual and legal consequences. First, breach of contract. If the budget doesn't align with payment schedules or deliverables defined in agreements, the project could face legal disputes or penalties. Second, stakeholder conflicts. Clients, vendors, or sponsors may dispute charges if the budget doesn't reflect agreed upon terms, damaging trust. 5. Poor risk management. Unmitigated procurement risks. Agreements often define risk-sharing mechanisms, such as liquidated damages. Poor analysis may leave the project exposed to unmanaged risks. In conclusion, agreements are critical inputs because they provide definitive cost data, ensure contractual compliance, and mitigate financial risks. Omitting them could result in budget overruns, misreported performance, or legal issues. A weak agreements analysis undermines budget reliability, increases financial and legal risks, and disrupts project execution. To avoid this, first, review all contracts thoroughly before budget finalization. Second, engage legal procurement experts to identify hidden costs. Third, align payment schedules with funding constraints. Fourth, update risk registers based on contractual obligations. How important is the input of enterprise environment factors to the determined budget process? The input of enterprise environmental factors is critically important to the determined budget process, as these factors influence cost estimations, funding requirements, and overall financial planning. Below is a detailed breakdown of their significance. 1. Influence on budget accuracy and realism. Enterprise environmental factors provide contextual constraints or enablers that shape the budget. For example, first, exchange rate fluctuations, such as in multi-currency projects, must be factored into cost baselines to avoid financial shortfalls. Second, market conditions, such as inflation and material costs, directly impact resource pricing and procurement strategies. Third, legal, regulatory requirements, such as tax laws and safety standards, can introduce mandatory costs. Without accounting for all these factors, budgets run the risk of being unrealistic or non-compliant. 2. Integration with budgeting tools and techniques. Enterprise environmental factors inform key tools used in the determine budget process, such as, first, cost aggregation. External factors like economic trends affect how costs are rolled up from work packages to the total budget. Second, reserve analysis. Unpredictable enterprise environmental factors, such as political instability, may necessitate larger contingency reserves. Third, funding reconciliation. Organizational policies dictate funding release schedules. 3. Alignment with organizational and external constraints. First, internal enterprise environmental factors. Organizational culture, resource availability, and project management information systems capabilities dictate how budgets are structured and approved. Second, external enterprise environmental factors. Government policies or industry standards, such as environmental regulations, can mandate specific budgetary allocations. Ignoring all these factors may lead to misaligned budgets that fail to meet stakeholder or regulatory expectations. 4. Risk management and adaptability. Enterprise environmental factors like economic volatility or supply chain disruptions are often sources of risks documented in the risk register. Their inclusion in budgeting ensures, first, proactive mitigation, such as hedging against currency risks. Second, flexibility to adapt budgets as external conditions change. 5. Strategic decision-making. Enterprise environmental factors link budgeting to broader business objectives, such as, first, business case alignment. External market demands may justify budget adjustments to capture opportunities. Second, stakeholder expectations. Social or political climates, such as public infrastructure projects, influence funding priorities. How can a poor enterprise environment factors analysis harm the determine budget process? A poor analysis of enterprise environmental factors can significantly harm the determine budget process in multiple ways, leading to financial inefficiencies, project delays, and even failure. Here's how inadequate enterprise environmental factors consideration can negatively impact budgeting. 1. Inaccurate budget estimates. First, unrealistic cost assumptions. Ignoring inflation, currency fluctuations, or market volatility may result in underestimated costs, causing budget shortfalls. Second, misaligned resource pricing. Failing to account for regional labor rates, material costs, or supply chain disruptions can skew budget projections. As a result of inaccurate budget estimates, the project may run out of funds prematurely, requiring additional approvals or scope cuts. 2. Non-compliance with legal, regulatory requirements. First, overlooked taxes, fees. Missing tax laws, import duties, or environmental compliance costs can lead to unexpected financial penalties. Second, violation of industry standards. Budgets that ignore safety or quality regulations may require costly last-minute adjustments. These factors can result in legal fines, project shutdowns, or reputational damage. 3. Poor risk management and contingency planning. First, inadequate reserves. If enterprise environmental factors like economic instability or political risks are ignored, contingency reserves may be insufficient. Second, unmitigated external threats. Budgets may fail to account for potential disruptions, such as natural disasters and strikes. As a result of these factors, we can have increased exposure to risks, leading to unbudgeted emergency spending. 4. Misalignment with organizational constraints. First, ignoring internal policies. Company policies on procurement, approvals, or funding cycles may delay budget execution if not factored in. Second, resource shortages. Underestimating internal resource availability, such as skilled labor and software licenses, can inflate costs later. As a result of these factors, we can have delays in securing funds or resources, derailing project timelines. 5. Stakeholder dissatisfaction and funding issues. First, unmet expectations. If budgets don't reflect stakeholder priorities, such as sustainability investments, support may erode. Second, funding rejection. Financial institutions or sponsors may reject budgets that lack realistic market economic justifications. Impact: loss of stakeholder trust, withdrawal of funding, or project cancellation. 6. Strategic missteps and missed opportunities. First, failure to leverage market conditions. Not capitalizing on favorable trends, such as low interest rates and bulk discounts, increases costs unnecessarily. Second, competitive disadvantage. Competitors may secure better pricing or funding due to superior enterprise environmental factors analysis. The impact of these factors can be higher project costs or reduced ROI. In conclusion, enterprise environmental factors are indispensable inputs to the determined budget process because they, first, ensure budgets reflect real-world constraints and opportunities. Second, enhance risk responsiveness and financial resilience. Third, align project finances with organizational and external realities. A poor enterprise environmental factors analysis can lead to the following consequences. First, underestimated costs can lead to budget overruns and funding gaps. Second, non-compliance can lead to fines, rework, and delays. Third, inadequate risk reserves can lead to unplanned expenses and crisis mode. Fourth, stakeholder conflicts can lead to loss of support and scope changes. Fifth, strategic misalignment can lead to wasted resources and failed objectives. As a final message, a poor enterprise environmental factors analysis undermines budget reliability, risking cost overruns, compliance failures, and project viability. Therefore, proactive integration of enterprise environmental factors is essential for realistic, resilient budgets. How important is the input of organizational process assets to the determined budget process? The input of organizational process assets is critically important to the determined budget process. Organizational process assets provide foundational resources and historical context that shape how budgets are developed, approved, and controlled. Here's a detailed breakdown of their significance. 1. Key contributions of organizational process assets to determine budget. Organizational process assets influence the budget process by providing, first, historical data. Past project budgets, cost estimates, and financial performance metrics help create realistic baselines. Second, templates and tools. Standardized budgeting templates, such as cost aggregation sheets and WBS-linked financial models, streamline the process. Third, policies and procedures. Guidelines on budget approval workflows, contingency reserves, and financial reporting ensure compliance. Fourth, lessons learned. Insights from previous projects highlight common budgeting pitfalls, such as underestimating risks or currency fluctuations. For example, historical cost data from similar projects can validate current estimates, while organizational policies might dictate how management reserves are allocated. 2. Specific organizational process assets used in determine budget. The process explicitly relies on, first, cost budgeting policies. Formal rules for budget structuring, such as tiered approval thresholds. Second, financial repositories, databases of past project costs and vendor pricing. Third, risk management frameworks, templates for integrating risk response costs into the budget. Fourth, reporting methods, standardized formats for stakeholder financial updates. Without these assets, projects risk inconsistent budgeting, misaligned stakeholder expectations, or non-compliance with internal controls. 3. Contrast with enterprise environmental factors. While enterprise environmental factors, such as market conditions and regulatory requirements, set external constraints, organizational process assets are internal tools that empower project teams to work within those constraints efficiently. For instance, an enterprise environmental factors might mandate adherence to tax laws, but an organizational process assets provides the template to calculate tax liabilities in the budget. 4. Practical impact. Projects leveraging organizational process assets effectively. First, reduce planning time by reusing validated templates. Second, enhance accuracy through historical benchmarks. Third, improve stakeholder trust with standardized reporting. How can a poor organizational process assets analysis harm the determine budget process? A poor analysis of organizational process assets can significantly harm the determine budget process in multiple ways, leading to inefficiencies, inaccuracies, and project risks. Here's how a poor analysis of organizational process assets can cause harm. 1. Inaccurate budget estimates. First, lack of historical data. Without reliable past project cost data, teams may underestimate or overestimate budgets, leading to funding shortfalls or wasted resources. Second, ignored lessons learned. Failing to review past mistakes, such as unrealistic contingencies and vendor overruns, repeats costly errors. For example, a project ignores historical data showing that software development costs typically exceed estimates by 20%, resulting in an unrealistic budget. 2. Non-compliance and approval delays. First, unused templates, policies. Skipping standardized budgeting templates or approval workflows can cause inconsistencies, requiring rework. Second, regulatory risks. Overlooking organizational financial policies, such as tax reporting standards, may lead to compliance violations. For example, a team bypasses the required multi-tier approval process, causing delays when finance departments reject the budget. 3. Poor risk management. First, inadequate contingency reserves. Organizational process assets often define reserve calculations based on past risks. Ignoring these leads to underfunded risk responses. Second, missed risk patterns. Historical risk registers help identify recurring issues, such as currency fluctuations. Without them, risks go unaddressed. For example, a construction project fails to allocate reserves for weather delays, a recurring issue in past projects, and faces cost overruns. 4. Inefficient processes and wasted effort. First, reinventing the wheel. Teams waste time creating budgets from scratch instead of leveraging existing templates. Second, stakeholder misalignment. Inconsistent reporting formats confuse stakeholders, eroding trust. For example, a project management designs a custom budget report, but stakeholders expect the organization's standard format, leading to rework. 5. Stakeholder and sponsor distrust. First, unrealistic baselines. Without benchmarking against organizational process assets, budgets may appear arbitrary, raising red flags for sponsors. Second, lack of transparency. Ad hoc budgeting undermines auditability, increasing scrutiny. For example, a project's budget lacks alignment with past similar projects, prompting sponsors to demand costly revisions. In conclusion, organizational process assets are indispensable to the determined budget process, offering both procedural guidance and empirical data to ensure budgets are realistic, compliant, and aligned with organizational goals. Conversely, neglecting organizational process assets can lead to redundant work, inaccurate baselines, and audit failures. Poor organizational process assets analysis undermines budget credibility, efficiency, and risk preparedness, key factors in project success. The PMBOK underscores organizational process assets as a foundational input for a reason. They institutionalize knowledge that prevents avoidable failures. This video is finished, but we will have in the next videos. 1. Creation of WBS for different projects using WBS Schedule Pro. 2. Examples of project plans using MS Project. And many more videos. Don't forget to give a thumbs up if you like this video and want us to continue with new topics. Subscribe to the channel. All content is free. You can also comment suggesting topics you would like to see on this channel. Thank you.